Welcome to the focusIR Fireside Chats with me, Karl West. I will be bringing you interviews with fund managers, economists and analysts. Plus, we'll be sitting down with the founders, directors, CEOs and company chairs that make things happen in the boardroom. I hope you enjoy the show. I'm joined today by Emily Barnard, who's Deputy Portfolio Manager at Edinburgh Investment Trust, which is run by Liontrust. Emily joined Liontrust in April 2022 as part of the acquisition of Majedi Asset Management, where she was an equity analyst for 6 years. Prior to joining Majedi, Emily completed a 2-year graduate program at the Wellcome Trust, focusing on equity analysis. EIT is one of the oldest investment trusts in the UK. It was established in 1889. The trust has 2 main objectives: to exceed the total return on the FTSE All-Share Index and grow its dividend faster than UK inflation. It's a UK-focused investment trust managed by Emily and Imran Sattar. Its biggest holdings are in high-quality, blue-chip, cash-generative companies like Shell, GSK, Unilever, Compass Group and National Grid. Emily, welcome to the show.
Thanks very much for having me on. Great to be here.
No problem. Emily, what would you say to those who grumble that the trust has missed out on some big gains over the past few years due to being underweight in banks and a lack of Rolls-Royce in the portfolio?
That is a very fair question. And yes, frustrating for us and of course frustrating for shareholders not to have fully participated in the very strong performance of the banks and not to have participated in the sort of extraordinary performance of Rolls-Royce. Sort of whilst performance, as we all know, goes through peaks and troughs, we are frustrated with the performance over the most recent period, recognise it's been disappointing and are resolutely sort of focused on getting returns back to where they should be. We spend a lot of time thinking about the shape of the portfolio and the right style balance in there, given the mix of the external macro and the bottom-up opportunities. And so naturally, we're spending a lot of time on that at present. To address Rolls-Royce and the banks specifically, the Rolls-Royce CEO has done a fantastic job in turning the business around, improving commercial terms, the margins on contracts, the balance sheet's improved, the external environment has also helped them out. And of course, it's a company and it's a share that we have discussed as a team, we continue to discuss as a team, thinking about the kind of those opportunities set against risks and valuation, which it's fair to say Rolls-Royce has significantly re-rated in recent times. And then the banks specifically, interestingly, over a 5-year view, and that's the investment time horizon we work with, NatWest has been one of the top contributors to the trust performance. But you're kind of correct to highlight, we've been underweight the banks and, most specifically underweight HSBC. Similarly to Rolls-Royce, they have a new management team in place. At HSBC, it's internal promotions. And they've done a fantastic job as well, taking cost out of the business, rationalising the portfolio of businesses, and really successfully growing the Asian wealth business. So today, the top 5 banks are sort of around 15% of the all share. Things are moving a little bit around at the moment, but around 15%. And we're around 10 to 11%. So still underweight, but modest. And it's just a function of where we see those bottom-up opportunities in the portfolio and in the market.
Yeah, you must get fed up of being asked that question, I'm sure. But at what point, when you start to see that this starts to become a bit of a trend, at what point in the investment cycle? You mentioned there you tend to look at things on a 5-year basis. At what point then do you kind of look at it and think, maybe we got that call wrong and perhaps we need to make a few little adjustments?
The question as to whether or not we've got, and this applies for any stock, Rolls-Royce, HSBC, other ones, that reappraisal of the investment thesis is pretty much a kind of ongoing, constant process. So like another share that we haven't owned, and not owning it has been a positive contributor to performance, has been Diageo. So that reappraisal as to whether we should own something, do we own enough of something, do we own too much of something, that's a kind of constant process. In terms of that 5-year view, I think what we got wrong at both Rolls-Royce and HSBC were the speed of the turnaround. So often these sort of large super tanker businesses can really take quite a long time to turn around. And at HSBC and Rolls, they've actually made like phenomenal progress. With Rolls-Royce, it's a question of valuation really. And with HSBC, we have added to that position. You know, you can see in the sort of latest couple of fact sheets, we've been adding to that position. I think they've done a really phenomenal business, and that Asian wealth business we think is kind of structurally set up quite nicely.
So just looking at the trust, the trust shares are currently trading at a discount to net asset value, I think of about 9%, but you can correct me if that's wrong. What are you doing to narrow that discount?
So important to highlight that share buybacks, which we are doing, they're a decision of the board. But of course, we are sort of all aligned on this with the shares trading on a sort of 8-9% discount to NAV. Buying back shares is obviously kind of very accretive. Accretive use of capital enhances the NAV per share for the remaining shareholders. So that's the kind of principally what the focus is at the moment, buying back shares.
Okay. This next question is a bit more of a kind of thematic one, really, about investment trusts. But we've seen, activist investors like Saber Capital taking advantage of these discounts and agitating for changes at investment trusts. We've seen it most recently at Edinburgh Worldwide. How concerned are you about this trend, if you like, and what are your thoughts, and how do you approach that?
So I say the first thing is mine and Imran's focus is just fully on the stock picking, portfolio construction, that 5-year view. I would say that investment trusts are a really brilliant vehicle for savers, and perhaps as an industry we haven't done enough to highlight to investors the benefits they bring in terms of gearing being additive over the cycle, resiliency, the ability to smooth dividends, and really importantly, the transparency and oversight that you get from investment trusts being a listed company and having an independent board. I think these are all really attractive characteristics that have perhaps flown under the radar a little bit. And so I'm hoping that we can sort of all use the additional attention that activists have sort of shone on the sector as an opportunity to highlight some of these important features of investment trusts. And any outside attention just highlights the value that there is in the sector.
Yeah, sure. Yeah, you mentioned stock picking there. EIT has about 45 stocks in the portfolio. How do you construct your portfolio? What do you look for in a potential investment?
So we take a total return approach to investing and constructing the portfolio. So looking at capital growth, income generation, and income growth. So a nice balance. And so the portfolio, we think, actually has a really nice kind of balance of stocks in there. Some are a bit higher growth and lower yielding. Some pay a bit more of a dividend yield. And then, some nice turnaround companies in there as well. Now, we want to run a portfolio for shareholders that is both economically and thematically diversified, as we think that will give us the best chance of delivering returns across different market cycles and investing with that 5-year view in mind. So really sort of not dogmatic about the type of investment in the trust, higher quality, maybe kind of higher dividend yields, some companies going through turnarounds. So flexible from that perspective. In terms of what we look for an investment, there really is no one kind. It's making an appraisal of where do we think the business could get to on a kind of 3-5 year view, and what are the shares pricing in versus the range of outcomes for that business. And actually when we look over shorter term performance, so the last year, interestingly, those turnaround companies have actually been delivering really strong returns. So we have a balance in the portfolio of higher yielding, higher growth and turnarounds. And it just so happens over the last year, the likes of Rentokil has done well, GSK has done really well, Anglo American has done really well. And they're all sort of turnaround companies of different kind of ilks, but all turnaround businesses. So there's no one type of investment, pretty flexible.
Of those businesses that you've just mentioned there, I know that they're very different in different sectors, but is there a common thread that runs through them? Is it something to do with, the strength of the management team, or just the fact that they're in sectors that are benefiting from the economy in their particular segment of the market?
I'd say the common thread, particularly between, say, Anglo-American, the minor, GSK, Global Pharmaceuticals, and Rentokil Pest Control, because very different sectors, the common thread would be they're all making internal changes to their portfolios, and they've all had management changes over the last sort of three to 5 years or so. So GlaxoSmithKline, for example, they have been turnarounds in pharmaceuticals take a long time, and they've been going through a turnaround for a while, but they have dramatically improved the R&D productivity in the business and the commerciality. They spun off Haleon 3-4 years ago, which is now the consumer health focused business. And so GSK sees internal changes around focusing the business, focusing growth within HIV, where they're very strong, within respiratory, within select areas of specialty meds. And then most recently, they've had a CEO change. And sort of we very much expect that process of improving R&D productivity, driving better commercial performance will kind of continue and accelerate under Luke. So it's kind of internal change plus some management change. At Anglo-American, I mean, there's a phenomenal amount going on in that business. They had a management change a couple of years ago. They've been going through a kind of cost optimization efficiency program, rationalizing the business as well. So a number of divisions, and actually the latest this morning announced that their Met Coal division is kind of now made a final agreement to sell it, and announced a merger with Tech Resources, and the approvals for that are currently underway. So again, that's a internal change going on, new management team, focusing on the really strong areas of value add within the business. Rentokil, slightly different. They are digesting a very large acquisition that they did a number of years ago, and it hadn't really gone to plan, and there have been some issues with integrating that. They've got a new CEO, a new FD in place, and sort of seem to be through the worst of that now. So I think with those three, the common threads are internal changes, refocus of the business, combined with management change.
When you're invested in companies like this that are going through such significant change, how much contact do you have with senior management?
So we like to, just as a general rule, we really like meeting management teams. I mean, for a few reasons. For that company specifically, particularly, as you said, for companies going through turnarounds, meeting the sort of change agents, if you like, and getting to know the management team and trying to meet some of the second layer of management down as well, we think that's really important to kind of understand what they see as their main priorities in transitioning the business. Often culture and sort of an upgrade of company culture can be quite significant in times of turnaround. So it's really important to sort of understand that aspect. And the other reason it's important to meet management teams, at least we think, is just to piece together that puzzle as to what's going on in industries, what's going on in economies. And that's part of our process that we call macro from the micro. So of course we do some sort of top-down macro, but the vast majority of our time is spent meeting businesses and building that kind of picture bottom up. So yeah, really, really like to meet management teams.
You mentioned a little while back that the trust has been buying back shares recently. You intend to continue that for the foreseeable?
So of course, a decision for the board on the share buybacks. You know, it's an accretive use of capital. And so, you know, we're fully aligned with the board that buying back shares at discount to NAV makes a lot of sense. But of course, any continuation of that kind of decision for the board.
Yeah. I'm just struck that by the diversity of your portfolio. Is there a quintessential EIT investment or not? And what has been your best performing investment, would you say?
No quintessential investment. I guess the quintessential aspect would be any company where we feel future prospects are kind of materially undervalued. But that can come in lots of different ways. It can come where we think the duration of growth is going to be longer than people expect. So, the likes of London Stock Exchange Group and RELX, we think the duration of growth at those businesses is going to be longer and at higher returns than people think. It can come from turnaround businesses like, the Anglo-American, the GSK. It can come from very cash generative businesses, and they can use that cash to either return to shareholders or to do maybe incremental M&A. It can come from, the likes of Diploma and Halma, where they do lots of kind of accretive bolt-on M&A. So no quintessential as such investment, kind of very broad range. The best performer, thinking back over the last 5 years, which we think is the appropriate time horizon, would be the top two would be NatWest and BAE. So despite being in aggregate underweight the banks, NatWest has been a really strong performer for us, as has BAE.
And I guess the reason for BAE is pretty obvious, really, with all the the focus on defence and military action. That leads me on, Emily. What's the current EIT or Liontrust view on the economic outlook for 2026, and how has military action in the Middle East impacted this?
So I think what the last few years have really sort of brought home quite strongly is that sort of short-term point predictions are highly likely to be incorrect. I'll share what Imran and I are thinking medium term. It feels like the plausible range of outcomes economically, geopolitically, politically, technologically with AI, it feels like that plausible range of outcomes is very wide over the next few years, and wider than we have seen historically, both actually at home and abroad. And so in general, that would call for more balanced portfolios stylistically, and perhaps portfolios with a slightly more defensive hue to them, and looking for companies where they have the resiliency to navigate a pretty changeable external environment, and maybe also businesses where they do have this element of self-help, some kind of internal change going on to help drive sort of idiosyncratic sources of upside.
Yeah, okay. That leads me on quite nicely. I was going to mention the predictions of, well, we're already seeing inflation feeding into all the forecasts. And my next question was, is this a time to increase weighting towards defensive stock picks? But I guess kind of, adding to that, what sort of things do you look for then if you are looking for something that's more defensive? Is it more some stocks that have got a kind of a solid track record of paying a dividend? What is it that you look for in these times?
I think particularly at the moment with inflationary challenges, with further supply chain challenges going on, pricing power is obviously it's a company's sort of one of their first defences. The defences would be a company with a very strong economic moat, with pricing power, and so they can manage the cost inflation we're seeing.
So market leaders in their sectors.
Market leaders in their sectors, that's a big kind of thematic in the portfolio. And generally these companies should be able to navigate, particularly versus peers within their sector, should be able to navigate sort of cost inflationary environment. Not necessarily, it won't necessarily be exceptionally good outcome for them, but they'll be able to manage it better than peers. Companies where at least short to medium term, they're sort of conservative on guidance, they're thinking conservatively, they're managing the business kind of to be quite resilient. So that's really what we look for, is strong, for defensive companies in this environment, strong market positions, good amounts of pricing power, and also companies with these sort of idiosyncratic internal changes going on that can help support performance, particularly in maybe more challenging external environments.
Thanks for that, Emily. Just one final thing before I let you go. Just was going to ask you some personal questions, really. How did you get into the investment sector?
Happy accident. So I wasn't someone that grew up sort of reading the FT. Originally wanted to be a physicist, so studied theoretical physics at university, but quite quickly discovered that sort of humans and markets interested me more than electrons. And my first real encounter with this part of the industry was my graduate programme at the Wellcome Trust. Just loved it, and so been doing sort of equity analysis ever since, really.
Brilliant. Well, Emily Barnard of EIT and Liontrust, thank you for joining me on focusIR's Fireside Chats.
Thanks very much.
Thanks for listening. Don't forget to hit that like, share and subscribe button on Spotify, YouTube or wherever you get your podcasts.